Come on. Push the button. Come on. Push the button.
What are you doing?
I'm just playing along. Come on, push the button.
Yeah, come on, push a button.
Blow everybody up.
Yeah, blow everybody up.
All right. Today is Thursday, February 10th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. What a day, what a day, what a day. Unbelievable action. You cannot find this kind of a freak show even on Netflix. We're going to cover all of the action that took place today. And boy, do we have a lot to talk about or what. So let's not waste any more time. And here it is. In focus tonight. The upcoming shock and awe, because it is the only option available for the Fed right now. Let's start by how the events unfolded today. In the morning, we got the jobless claims for the week. And the numbers were revised lower, which is good economic news, but also bad for the stock market. Why? Because the number went down from 239,000 claims to 223,000 claims. Once again, good economic news. We have less unemployment claims. Why is that bad news for the stock market? The answer is because it gets us closer to Fed Chairman Jerome Powell's maximum employment threshold. What happens when we get to the maximum employment threshold? Supposedly, the economy will no longer need the so-called accommodation by the Fed, aka the cocaine, which is the trillions and trillions and trillions of dollars of liquidity. The problem is the stock market has been a junkie to this liquidity. It cannot function without the Fed's liquidity. So good economic news pushes closer and closer to the end of QE, meaning no more coke for the stock market. So it was bad to begin with. And then came the next shoe, inflation. Now, we knew ahead of time that this reading will be hot. And the reason is we're seeing inflation all around us. Food, gas, cars, rents, all over the place. The average household is spending an extra $250 a month or $3,000 per year due to inflation. And I say all of these numbers are tamed down. It's a lot more than $250 a month. But regardless, the expectations were for a hot number. The problem is, and the confusing part, at least vis-a-vis the market, was why did the market shoot up higher yesterday? Because the assumption when we saw the action of the market yesterday is perhaps something leaked out, perhaps the reading of the CPI will be milder than expectations, and therefore we're seeing market manipulation efforts to get ahead of time and buy stocks. This was the assumption, and then came this.
Now for the biggies, 7.5 on year-over-year headline, 6% on year-over-year core. Let's go to the whiteboard. So 7.5%, and that is, of course, on headline. You have to go to 1982 to find a higher number. And, of course, when we look at 5.5 on core, well, 5.5, December of 21 was 5.5. So, therefore, we are equaling what we have seen last, but no, it came in at 6%. So now we have to go down on the whiteboard to August of 82. So those are your numbers on the year over year. That's what everybody's most concerned about. We were supposed to see some alleviated pressure on the monthly read. We could frame it quite simply. 1/3 of CPI is housing, it's rent, home equivalent rent. And we all know that it's very unlikely these rents, which have been surging, are going to be going down anytime soon. We know labor costs probably aren't going to be going down anytime soon, even though they are far from, at least at this point, competing with the actual rate of inflation. It's lagging. So even though wages are up close to 5%, they're not keeping up with inflation, but they're also most likely not going to go down.
Once again, this was a hot reading, blowing above expectations, even after the cooking, because you and I know that the CPI, aka the CPI, tames down the true picture of inflation. In reality, we know that we have double-digit inflation in this economy, at a minimum. So forget about 7.5, that's garbage. The true number of inflation, if it was counted correctly, would be at least 15%, but they say it's 7.5, and it is the highest since 1982. And look at Jerome Powell with the dumb look on his face. Did I cause all of this? Am I responsible for all of this? Yes, you are, you dummy. Why do we say that inflation is at least at double digits right now in this economy? The answer is housing and rent costs, which the CPI doesn't count at all. They have a cute formula that downplays rent inflation by a lot. Look around you. Rents went higher by 10, 20, 30, 40, even 50% in certain cases. Yet the CPI says that shelter costs, which accounts for about 1/3 of the CPI, increased only 0.3% month over month and 4.4% year over year. What a joke. Really? Your rent went higher by 4.4%? Give me a break. And therefore, we call it the CPI. Look at inflation in certain cities, by the way. And once again, these are the tamed down, watered down, cooked down numbers. But even with that, these numbers are stunning. Tampa, Florida, almost 10% inflation. Riverside, California, 8.6. San Diego, 8.2. My ass. It's at least 20% in San Diego. I live here. I know what's going on. But it goes on and on. Denver, 8%, Dallas, 7.8%, LA, 7.5%, and it goes on and on. And of course, you heard it, Rick Santelli of CNBC says that inflation is not going to stop here because you have wage inflation, that's unstoppable. And then you have rent inflation. Your landlord is not going to come to you and say, you know what, I'm going to decrease the rent because inflation turns out to be transitory. They're never going to do that. So we have sticky parts of inflation. Among them, not just rent and wages, by the way. If you listen to corporate earnings, all of them, specifically consumer staples companies, they say we increased prices and we're planning to increase prices even more. Today we heard from PepsiCo and Coca-Cola. Similar story. The earnings for these companies, revenues and profits at all-time highs because they're increasing prices. They have the pricing power. The consumer remains receptive for now, and they see more price hikes to come. So once again, expect prices to go higher and higher and higher. But you got to use your head here in buying stocks. You buy stocks of companies that are inflation proof. Now, I know there is no such thing as inflation proof forever because at some point, companies will not be able to increase prices without deterring customers away, even if inflation continues to rise higher for them, meaning their input costs. But for now, the only guideline we have is earnings. You got to look at earnings and look at companies. Are they increasing prices higher? That's check mark number 1. Is the consumer receptive, at least for now? That's check mark number 2. Is the pace of growth of revenues higher than the pace of growth of expenses? That is check mark number 3. These are the only companies you want to be invested in right now. Another one. Look at this. Kellogg's. They're also saying that they're going to raise prices higher again in 2022. And listen to this. The CEO of Kellogg's sees double-digit inflation. Why? Because we already have double-digit inflation in the economy, despite what the CPI says. The CEO of Kellogg added, we don't want prices to get too high, but we are in an environment where it is broad-based. It's across everything, but we've been able to cover it. Our pricing performance has been very solid, he said. And look at this. The CPI right now, way above the last time we saw high inflation in 2007 to 2008. We're now reaching almost 8% inflation. This is the official government number. And again, you look at all categories. Look, for example, at the gray column for services. That is up year over year. In green, that is goods. Also up year over year. Food, stunning inflation. Year over year, a month over month. Look at that. Energy, similar story. Everything is moving higher with no stop in sight whatsoever. And even when we look at the month-over-month numbers, the headline reading remains static. And there is a lot of talk by the propagandists today that perhaps inflation is peaking because the month-over-month reading is pretty much the same. Baloney. One thing they're not telling you is the following. Remember when they said that inflation is due to the reopening of the economy? Remember that lie? Look at the month-over-month inflation. Look at the blue column, the blue part of the column. This is for the non-reopening components of the economy. The inflation month over month in this category is absolutely stunning, and it was pretty much solely responsible for the elevated inflation reading that we got today. So it's not due to the reopening. It's not transitory. We're seeing massive inflation in the non-reopening components in this economy. Online prices were up 2.7% in January from a year ago. Online grocery prices surged 5.8% year over year. And this is the 24th consecutive month of price increases. And folks, when I read the CPI report, in every category, the most stunning part of inflation is food inflation. It is surging out of whack in an unbelievable, rapid manner. And this is the most dangerous part of inflation. Energy costs, gasoline prices moving higher. Okay, maybe we'll take the bus. Maybe we're going to drive less. Maybe we can work from home. Inflation in the unnecessary goods prices or services prices, we can do without. We can lower the standard of our living. We can expect less as they want us to. But when it comes to food inflation, what are you going to do without that? You're going to eat in the metaverse? You have no choice but to pay the extra cost. To eat, to live. And hence, food inflation is absolutely dangerous in this economy. It's going to push the Fed to do whatever it needs to be done to tame down this inflation, meaning, once again, the shock and awe approach. And by the way, at this point, it is absolutely stunning and unacceptable that at this point, after the reading that we got today, the Fed remains so-called accommodative. They continue to buy assets. They're still buying bonds. They're still buying mortgage-backed securities. Interest rates at zero, which is absolutely unbelievable given the fact that we have this inflation. But this is just yet another illustration of the lunacy, but most importantly, the incompetence of the Fed. And keep in mind that all talk about peak inflation is garbage. It is absolute filth, just like the transitory talk. Now we're hearing, peak inflation, peak inflation, peak inflation. Really? What do you say about wage inflation and labor costs? That's not going to go down anytime soon. Take, for example, the fact that we're seeing more Starbucks stores unionizing. And this is becoming a movement, not just in Starbucks, but you're going to see it more and more and more. Folks are not going to work without getting a quote-unquote living wage, and therefore inflation will continue to move higher. Another one, when we talk about wage inflation, the headline from the Washington Post reads, Biden to propose 4.6% pay raise for federal employees, the biggest hike in 20 years. Look at him smiling, as if he's extending his generosity to these federal employees. You're giving them 4.6% increase in wages. Meanwhile, CPI inflation is at 7.5%. Net, even with the increase, they're losing money. And no wonder why we're seeing unionization efforts even within federal employees. They're going to push for higher wages. They're not going to work for starvation wages, and the federal government will have to compete for talent, which means federal employees' wages will move higher. Again, what does that mean for you and I? Higher taxes, baby. And here he is. President Biden comes out and says he knows that inflation is creating great stress at the kitchen table.
Come on, man.
And I say, Mr. Biden, we had to sell our kitchen table because inflation. We sold it to raise money. So maybe you meant the kitchen floor. Anyways, the president remains optimistic about the American economy, even after consumer price index surged beyond expectations. And here comes Joker Ryan Newman, who gives the Biden economy an A-. I wish I had professors like Rick Newman back in college. All of these D- grades that I got, they could have been A-. Think about it. Could have gone to Harvard. Anyways, another one when we talk about the sticky part of inflation. Wages, rents, prices from consumer staples moving higher. And then we have, here it is, truckers' wages, the inflation in trucking. We're seeing a movement across the country, started by Canada, and now it's being contagious. They're talking about truckers protesting the thing and the restrictions. But I have a hunch that in reality, that they're also protesting the working conditions of being a trucker. They want higher wages. They want better benefits. They want a better infrastructure for truckers. They want more vacations, more off time, etc., etc. What does that mean? The economy needs to hire more truckers. We cannot find them. The ones we have right now are unsatisfied. So wages for truckers will continue to move higher and higher and higher. And again, truckers are the backbone of this country. Everything moves coast to coast, port to store via trucks. Now, if the cost of transportation for goods moves higher, then what do you think will happen? All of these companies selling the goods will move prices higher to compensate for the extra cost in transportation. Hence, you and I are going to pay more. And there is no end to that. Whether the Fed increases interest rates or not, truckers are not going to say, oh, you know what? Jerome Powell raised interest rates by 1%. I guess inflation is going to go down, so we're not going to ask for better wages, more benefits, yada, yada, yada. Not going to happen. They're still going to ask for better wages and better working conditions, a more off time, most importantly. And this is the kind of inflation that's not gonna go away. Now, let's talk about the market's reaction after the CPI came out. We saw a trap yesterday. They gapped the market higher. What do you know? The CPI comes out hot today and the market gaps down. And we talked about that in yesterday's video. That I'm smelling a trap. You cannot rally like this ahead of the CPI. Unless you know the number and you know how the market is going to react to that number. Otherwise, they're just trapping you here. They're creating a bull trap to get as many buyers from the mom and pop crowd, and then boom, trap them, take their money, goodbye. And this is exactly what happened in the morning. But what do you know? The market caught a bid in the morning right away. An aggressive bid, and the majority of the indices closed the gaps. As a matter of fact, some of them even managed to trade in the green for a little while. The Dow Jones was down over 300 points in the morning, and after the pump, it managed to trade in the green, erasing almost 300 points loss in the morning. Now, make no mistake, look at the chart. It's laughable. It is comical. This was a market manipulation effort by a certain entity that pumped the market higher in the morning, trapping many retail investors and traders into buying the dip. And here's what I tweeted in the morning, because I look out for you. I tweeted this, 6:42 in the morning, Pacific time. The market was trading for a little over 10 minutes. And I said this, dip buyers did not learn from yesterday's trap. They're digging their grave once again. 6:53, I tweeted that perhaps this is the plunge protection team once again, giving us the illusion. Don't worry about inflation. It might be hot, but it's peaking. Come on, buy stocks. They want to give us the illusion that nothing will happen to the stock market if they raise interest rates higher. And then 7:14 Pacific time, I tweeted this. It sounds to me that certain entity, quote unquote, manipulated the market higher yesterday in anticipation of a milder CPI. Today, they did not get that. So they are resorting to the plunge, aka market manipulation, just to get them out of their bets from yesterday. And then they'll flush the market again. You might be reading all of this and asking, this is market manipulation, it's clear. Where is the SEC? I got news for you. The SEC remains in a coma. Why is the SEC in a coma? Perhaps this explains it. Your beloved politicians, in this case Elizabeth Warren, who we praised in this program before, we're going to criticize her now because she came out turning up the heat on the SEC. To do what? To address market manipulation? Of course not. She wants them to address climate change. What a joke. What is the SEC supposed to do about climate change? But here it is, back to the action that we got today, 9:03. I tweeted this, plunge protection round number 2. The market dived down and they pumped it higher again. And then 9:55. The plunge finally broke. Goodbye. So indeed, all in all, it was a pump and dump. They pumped the market in the morning, trapping a lot of bulls, a lot of mom and pops, retail investors, of course, who bought the dip, and they buy any dip, by the way, because they're a bunch of zombies high on meth looking for the next score. They're not functioning rational human beings anymore. They run Naruto style, heads first, buying the dip, asking questions later. Matter of fact, don't ask questions at all. Hello, the CPI came out hot. Party's over. Go home. But they buy the dip again. Why? Because they're programmed on autopilot to buy the dip over and over and over again. And who broke the plunge, by the way? What was the reason for the flush down that we got around 9:55? The answer is, how about St. Louis Fed President James Bullard, who gets high in the morning, the eyes don't lie, and he issues blunt statements all the time. And in this case, Bullard says that he supports raising interest rates by a full percentage point by the start of July, including the first 50 basis points hike since 2000. And now the odds for a 50 basis points hike in March went higher by 100%. So it's in the bag now. 100%. The Fed will increase interest rates by 50 basis points in March. Do you think that that's not going to rattle the stock market? Think again. Bullard says, I'd like to see 100 basis points in the bag by July. And by the way, Bullard is now a voting member. You cannot ignore him anymore. He also added, I was already more hawkish, but I have pulled up dramatically what I think the committee should do. And just so you know, there are tensions within the Federal Reserve. You got Bullard, you got Boystick, you got Harker, the Hawks versus the Doves. Powell, Williams, Daly, Mister, and the rest of the zombies. And here it is, expectations for interest rate hikes went higher post the CPI release. And we're talking by a lot. We're now saying 25 basis points hikes, 4 of them priced into July. We're going to get a 1% interest rate hikes by July. And I say forget about that. The way things are going on right now, we could get a 1% increase by March because the Fed is way behind the curve. And this is what we've been warning about over and over and over again, at least in this channel. Mr. Powell, you're too late. You're going to say it's transitory. Sooner or later, you'll find out it's not transitory. By the time you find out that it's not transitory, it will be too late, and you're going to have to slam your foot in the brakes aggressively, and this will crash the stock market, the real estate market, and the economy. In response to the CPI, the rate on the 10-year yield jumped higher above 2% for the first time since 2019. And this has ripple impacts across the economy. For example, mortgage rates also jumped higher by double digits in a single day. Not seen for a long time. Matter of fact, mortgage rates are now reading at the highest levels since January of 2020, meaning all of that drop since the beginning of the thing, that's poof, gone. We're back to the same levels of January 2020. And oh, by the way, prices are still at all-time highs. The dominoes are falling, folks. The meme stocks are gone. The small caps are gone, the mid caps are gone, the high multiple names are gone. Little by little, they're going to crash every single corner of the stock market. The bond market is crashing. Then comes the real estate market with mortgage rates moving higher, prices crashing down. Next thing you know, the economy starts losing jobs, we dip into a recession, and here we go again. Thank you to the insane Federal Reserve's engineering of the economy. The Fed right now is stuck between a rock and a hard place, and they are in a lose-lose situation. And it's actually a lose-lose situation for us and the economy. They don't care. They already sold their stocks at the top. They're all a bunch of millionaires. What do they care? But right now, it is pretty much impossible to engineer a so-called soft landing. The soft landing is garbage. The soft landing is filth. The soft landing is a fantasy. It's never going to happen, just like transitory. There is no soft landing here. There is a price to pay. The chicken are coming home to roost. They are simply too late. Listen to Mohamed El-Arian, what he said today.
It is amazing to me that the marketplace now expects 150 basis points of hikes this year and is starting to front load, as Steve said, the hiking cycle. That is serious. So they've got to do two things quickly. The trouble, Melissa, is they're so late that I can't think of an easy way to do this. And this is the one thing we all wanted them to avoid. We didn't want them to be in a lose-lose situation, and increasingly they're being forced into a corner of just lose-lose.
Mohamed, just to get a little more specific on what Bullard is putting out there, he wants 1 percentage point of hikes by July 1st. So that would be 100 basis points in 3 meetings, therefore 50 in one, 25 in 2 others, as opposed to by the end of July when there's another meeting and you might be able to get to your 100 basis points 4 weeks later. Is that really the difference between the Fed having this methodical start to a tightening cycle that the markets can handle and a Fed policy error?
So what he wants, and we should all want it, is regaining control of the policy narrative and of policy credibility. So his way of doing it, and it's not only his way, others are proposing this, is move quickly, show that you're serious, and contain inflationary expectations. Inflationary expectations are starting to move, not only to compensate for past inflation, but also to anticipate future inflation. So his idea is move quickly, restore your credibility, and then wait, see how the data evolves. And that is a more orderly way of doing it. The trouble is that if they don't get it just right, they risk having to hike again, and then you worry about the economy, and you worry about the typical mistake, which is when you slam on the brakes, you increase the probability of a significant slowdown, and you hurt corporate earnings.
And indeed, the window for the so-called soft landing is over now. We have 3 scenarios going forward from this point on. Number 1, if the Fed catches up by tightening aggressively, meaning 50 basis points or more in March, and let's say up to 10 interest rate hikes this year. The aggressive approach will crash the stock market, real estate market, and the economy. We will dip into a recession 1,000,000%. No doubt about it at all, because raising interest rates aggressively always crashed the economy and the stock market. And you and I know that right now we have an economy that tracks the stock market, not the other way around like it's supposed to. Thank you to the Fed's engineering of the economy and the financial system. So when stock crash, look no further than Peloton, for example. They have to get rid of employees. Thousands of them. The story of Peloton will be replicated across the economy when stocks start to crash. We must ask the question so we don't repeat these mistakes again. All of these trillions that they spent due to the so-called emergency, how come we did not get sustainable gains from all of these trillions? How come at the moment when the Fed starts to increase interest rates, everything goes away and collapses? I thought the trillions of dollars were supposed to save the economy and keep it afloat against challenges. Well, clearly, this strategy has failed. We knew it was a failure ahead of time. Nobody wanted to listen, but we're going to live with the ramifications and the consequences from printing trillions and trillions and trillions of dollars out of thin air. And the majority of that money, magically, of course, floated to the pockets of the 1%, and the economy got nothing. Zero. All of these trillions. No sustainable gains whatsoever. The moment the Fed raises interest rates, the moment the stock market crashes, we lose all of these gains, all of these jobs that they've been bragging about. They go away. So next time they say, oh, the economy is in a recession. We gotta ease the monetary policy once again. We gotta print trillions more to rescue the economy once again. The public should be outraged because that approach failed once, failed twice. Fool me once, shame on me. Fool me twice, shame on me. Fool me a third time, and you know what's going to happen. This economy and financial system, after the crash and the collapse, must be rebuilt with another approach, a bottom-up approach, an organic growth kind of approach. Mom and pops, small businesses, affordable housing, not the crony capitalism, the gangsterism that we have right now. Anyhow, the next option for the Fed is do nothing, keep QE, maybe do away with the purchasing programs, no more bonds, no more MBS, but keep the rates where they are. What do you think will happen? Hyperinflation. Prices will continue to move higher and higher and higher to the point where we have hyperinflation. Option number 3, they can do gradual tightening. They try 25 basis points in March, which the oligarchs want. You heard Rubenstein yesterday. And then they increase another 25 basis points in the next meeting, and so on and so forth. Well, this approach will ensure that we have stagflation in the economy because the market looks forward. And if the market sees more interest rates on the horizon, the market goes down and we see losses of jobs in the economy combined with the slowdown of the pace of economic activities and growth. Yet the impact on inflation, historically speaking, has a lag, meaning the Fed tightens right now, we're not going to see the impact until September, at a minimum. So in the meantime, you're going to see higher inflation and a slower economy, hence stagflation. These are the only options that the Fed has right now. Maybe we can be cute, but it's already too late for that. And I said, don't tell Jerome Powell this, but what if? What if he decided to raise interest rates higher last year, but yet did not taper the purchasing programs of bonds and mortgage-backed securities? Maybe doing that approach could have drove inflation down, yet kept the stock and real estate markets afloat. Maybe we'll explore that in a paper someday. But right now, it's too late. You got 3 options: recession, hyperinflation, or stagflation. And the most likely scenario to happen is recession. Hyperinflation, doing nothing, is too risky right now. And we have an election coming. There is no way that the Fed will keep the same policy and continue quantitative easing all the way to the elections. Not going to happen. So we scratch that out. What about stagflation? Could the Fed increase interest rates gradually? They could, if they want to continue to prop up the stock market. It's not going to happen, but they could try. And here's why I say this is not a practical approach. Number 1, the Fed is under scrutiny right now from the left and the right, and the reason is they're way behind the curve. Number 2, the elections. If the Fed is mild in its approach of tightening the monetary policy, they could be seen as playing politics, favoring the other side by keeping inflation higher all the way till elections. Not going to happen. The most practical approach right now is the shock and awe approach of increasing interest rates by 50 basis points or more comes March. And the bet will be, yes, the market will crash. The economy might dip into a recession for a little while, but by the fall, everything is going to recover. The stock market will recover, and the economy, because we've built so many gains, these gains are going to stick, and we're not going to dip into a severe recession, at least. This is the fantasy, the assumption. And I say it's not going to happen. Why? Because once again, even if you increase interest rates by 50 basis points in March, there is a lag. We're not going to see the impact on inflation until after September. What does that mean? The Democrats are toast, Biden's toast, and certainly Jerome Powell is toast. Oh, and by the way, the stock market is toast. Why do I say that this is the most likely scenario, by the way? I have facts to support me. Look at the yield curve, for example, the spread between the 2 and 10-year yields. In a healthy economy, we see a steep yield curve, meaning this chart moving higher in a steep fashion, indicating the future prospects of growth in the economy are getting better. But when you see a flattening yield curve, and even worse, an inverted yield curve where the 2-year pays more than the 10, the message from the bond market is this economy has no prospects of growth in the future, and it's going to dip into a recession sooner or later. And by the way, the last time the yield curve was inverted was in 2019. We all know what happened in 2020. There is a rule that says always trust the bond market. Now, what are we seeing so far? Are we seeing a steepening yield curve or a flattening one? The answer is it is flattening by the day. And soon enough, we're going to see an inversion of the yield curve, and that would be a solid, reliable indicator the recession is on the horizon. Lastly, the propagandists, the pumpers, the cooks, the bureau and the government, CNBC, the Wall Streeters, the analysts, all of these folks will come out and say, hey, look at the bright side. Inflation is peaking. What are you talking about, you might ask? Or better yet, what are you smoking? They will present you with this. The month-over-month inflation is pretty much flattening. We're not seeing a massive increase month-over-month in inflation. Yes, we're seeing year-over-year, but we're not seeing month-over-month, and perhaps this is a leading indicator that inflation is flattening, is peaking, and it's going to move down from this point on. This is all done by design to prop up the equities market. In reality, prices will not go down for the consumer. We're still going to be stuck with higher prices. Being stuck with higher prices means a lower purchasing power. A lower purchasing power means less spending in the economy. Less spending in the economy means lower profit margins, lower earnings and revenues for companies, which means lower stock market, which means a stagnant economy. Don't listen to me. Listen to Jerome Powell, who admitted that by transitory inflation, he doesn't mean that prices will go down. He just means that the rate of increase year over year and month over month will slow down. This is what he means by transitory inflation. But those prices, those high prices, they're not going to go down. Take a listen.
The concept of transitory is really this. It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen. So there will be inflation, but that the process of inflation will stop, so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example and not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back. That's not the idea. It's just that they won't go on indefinitely.
Anyhow, we're going to move on to cover the market information for you. We start with the performance. Here we go. The Dow Industrial Average down by 526.47 points, or a decline of 1.47%. The Nasdaq down big, 304.73 points, or a decline of 2.10%. The S&P 500 also down by 83.10 points, or a decline of 1.81%. What about the sector's performance today? Every single sector of the market is down in the red, so we're not going to give any medals today. The laggards were led by technology, utilities, and REITs. What about the advance to decline ratios? NYSE 22% advancing versus 75% declining. Nasdaq 26% advancing versus 71% declining. Futures, commodities, what's going on here? The risk of increasing interest rates higher aggressively will also hit commodities. So we have to look at the resiliency of certain commodities today, namely crude oil. For example, the WTI actually closed in the green today, gaining almost half a percentage point today. On the other hand, it was a flattish day for Brent, gasoline, and heating oil, while natural gas continued to drop, losing almost 2% today. Softs, we have declines led by OJ, coffee, sugar, and cotton. Lumber was flat. On the other hand, cocoa moved higher by almost 0.75%. Metals muted, gold, silver, platinum all down, be it modestly. On the other hand, the laggard is palladium, losing a little over 1%. What about meats? Losses across the board led by the new big tech. Even the new big tech is down. You know it's serious when the new big tech is down. Lean hogs, feeder cattle, live cattle, all down. No mercy whatsoever here. Grains, similar story. We have losses led by oats, rough rice, soybean meal, wheat, soybeans, canola, corn, all down. The only commodity lining up green in grains is soybean oil, gaining a little over half a percentage point today. But we have to look at the inventories for soybeans because they're not moving higher. Matter of fact, they're reaching 6-year low this season. So again, shortage of supply, lots of demand. Soybeans remain a hot trade here. Moving on to the big casino, the options market. What's going on here? The hottest table by far is Apple, with a little over 1 million contracts traded today. About 59% of those were calls. Tesla, the souffle, at number 2, with almost 900,000 contracts traded today. About 55% of those were calls. At number 3, the ticker AFRM, Affirm. What a mess that took place today. The earnings were leaked ahead of time. There was a lot of manipulation that happened today, and the stock crashed before the end. We'll talk about Affirm in another video because it's unbelievable what happened today. Anyhow, about 670,000 contracts traded for the name. About 67% of those were calls. Moving on to the unusual activities that took place in the options market today, we start with the ticker IWM for the Russell 2000 small caps. They're buying the 190 puts, betting for more downside for the IWM with the expiration date of March 14th. With the expectations, the IWM will drop down by more than 6.5% by then. They paid about $2.70 apiece to enter this trade. All in all, spending about $7.5 million. What about the trade for the ticker GLW Corning? They're buying calls here. Interesting. The 45 calls for the expiration date April 14th. With the expectations that the name could pop higher by more than 6% by then. They paid about 85 cents apiece to enter this trade, all in all spending about $850,000. What about the trade for the ticker QQQ, the Nasdaq? They're buying calls, once again, interesting, given what happened today. In this case, they're buying the 405 calls for the expiration date March 25th, with the expectations that the name could pop higher by more than 13% by then, and they paid about 50 cents apiece to enter this trade, all in all spending about $400,000. Another interesting trade, given what happened today, is the one for the ticker TSLA, Tesla. They bought the 970 calls for the expiration date February 18th, with only 8 days till expiration, with expectations the name could pop higher by more than 7% by then. They paid about $8 apiece to enter this trade, all in all spending about $4 million. Moving on to the heat map analysis, what's going on here? A sea of red, pain across the board, with the exception of certain names that reported earnings, mainly Disney, Micron. I will dig more for names that actually bucked the trend due to earnings and otherwise, but you gotta pay attention to Meta, Facebook, because it is becoming a battlefield. The market will not recover. Once again, I repeat, the market will not recover absent of the stock of Facebook recovering. It's a sentiment indicator at this point. We have bad news for Meta, by the way. I highly recommend that you read this article. It says Meta is now calling out Google over Apple's app privacy rules. The tide has shifted here, and everything is getting stacked against Facebook here, be it the duopoly of Apple and Google or internal problems of the overspending on the metaverse. The notable movers that bucked the trend today, along with Disney and Micron, how about Honda, HMC, a name, the only name, by the way, that I bought this year. The only stock that I bought this year is Honda. Honda's moving a little higher, while Tesla's down, Ford is down, NIO's down, Toyota down, everything is down. And by the way, Honda pays a high dividend. I believe right now it's 3.5%. It's a value name. The risk versus reward says it is a safe place to park some cash here. And by the way, year to date, Honda, HMC is up 8%. Everything else is down. Tesla, NIO, GM, even Ford, with the exception of Toyota, which also happens to be another value name, although I did not like their earnings that came out this week. When we look at the monthly chart for Honda, as you can see, we have a descending line, a sloping line of resistance that goes back all the way since 2011. And the chart tried over and over and over throughout the years to break above that sloping line with no success at all. So what is different this time around? Number one, the EV mania, the EV optimism. Every single auto manufacturer got a premium for the EV mania, with the exception of Honda. Now, technical wise, we have a formation, what it appears to be at least, a reverse head and shoulder formation, which could take the stock to break above the sloping line of resistance once and for all. So I remain bullish on Honda. Another one, we have the ticker K. Kellogg reported earnings today. We talked about it in the beginning of the video. We also have Mattel, the ticker MAT, surging higher today by over 7.5% due to earnings. We have more optimism for the name because the upcoming Barbie movie will come out next month. Or, excuse me, the production will start next month. And spoiler alert, by the way, in the opening scene of the movie, Barbie will be with her friends at the bingo table playing with no dentures on. So just tame your expectations down. Barbie's an old lady now. She's 63 years old. Give her a break. Anyways, moving on to the heat map for the ETFs. It's a sea of red, absent of the inverse indices. If you had the SQQs, the SPX, the TZA, or even the VIX proxies, VXX, UVXY, you scored big. You also have the TBT, which tracks the 10-year yield. That was up. The only international market that was trading higher today is my pick, once again, the EWZ. Unfortunately, I'm out now. I took my profits, so I'm not enjoying this little bump higher that bucked the trend today. Moving on to charts, and we start with SPY 30 minutes chart for the S&P 500. Again, we opened gapping down. You saw the pump, the market manipulation effort, catching support almost from 451. Then it moved higher, closing the gap, and everybody gets excited. You read the tweets, the comments, everybody says, forget about the CPI, they're gonna shake it off again, the market only goes up, yada, yada, yada. What do you know? Bullet comes out, and the chart flushes down, losing the support of 454, 451, and we're now looking at 446.5 for support. That is likely not going to hold, and you got to remember my magic number, which is 444. You break below that, you're going down to retest the line in the sand at 430, and in all likelihood, that's not going to hold. The bears are closing in. They scored significant gains today. Major victory for the bears. Thank you to Bullard. Anyways, here's the daily chart for the S&P 500. We had a bull flag. It played to the upside. SPY futures recaptured 4,549.5 as resistance. Support. So far, so good. But I told you yesterday, a move like this ahead of the CPI is risky. Matter of fact, the risk is to the downside if we get a hot reading. And frankly speaking, the bulls, they shouldn't be called bulls. They should be called pigs. They're absolutely stupid. How could you read the CPI in the morning and assume that the market is going to go higher? Don't blame it on Bullard. Blame it on your stupidity. You bought when you shouldn't have bought. The CPI was hot. The 2-year yield exploded higher. All the signs and the indicators were out there that this rally will fade quickly. So what do we have now on the chart? The bulls still have 4,472. The magic number is still intact. If that is lost, then the bulls have nothing. Zero, because the momentum indicators are curling down, the volume spiked higher on the selling side, and oh, by the way, we have what it appears to be a double top formation, and on top of that, we have a clear reversal candle because it covers the body of the previous candle and it closed below the lows of that candle. What about the Qs? 30 minutes chart, what's going on here? Similar story, the pump catching support from 360. This was the tough number, by the way. The chart struggled to crack above that number and they decided to cheat their way by gapping above 360. Well, you know what? This is all disrespectful to 360. And now we saw the revenge. 360, pulling the chart down and then some. Once you lose the support of 360, you're going down to 352. If that fails, it's over. We're going back to 343, the line in the sand. In all likelihood, that's not going to hold either. And here's a daily chart for the continuous contract for the Qs. Again, it was a bullish formation. We saw the momentum indicators curling higher. We saw the volume receding, and perhaps a formation of an ABC pattern or a bull flag. Doesn't matter to me. The chart recaptured 15,000. It was looking beautiful for the bulls. But again, there are limitations to technical analysis. The fundamentals matter. The Fed's policy is supreme above all things. And therefore, I said a move higher before the CPI is undertaking a lot of unnecessary risk because you front loaded all the gains. The CPI comes hot and you're going to flush down. And this is exactly what happened today. The momentum indicators are curling down again. The volume spiked higher on the selling side. The support of 15,000 is lost. And the candle that we got today is a reversal candle. It dwarfs the body of the previous candle, and the lows of today's candle is below the lows of yesterday's candle. Now that we got a reversal, you're not gonna fight it. The assumption for now is the market is going down. What about a 30-minute chart for the IWM, the Russell 2000? Similar story here. You had the gap down, the rescue candle, the plunge protection team got us all the way above 208. Then comes Bullard, you know the story, and the IWM closed at the lows of the day. Not a good sign. Lost the support, 204.5. In all likelihood, we're going down to retest 196.5 as support. And here's a daily chart for the Dixie, the dollar index. Really interesting move today. You'd think, looking at what happened in the stock market and the bond market, that the dollar must have popped big time. Not true. The dollar was pretty much flat. It went up, it went down. Is the dollar sending a message here? I'm not sure. But it certainly failed to recapture 96. So for now, we're placing the bear flag pattern. I don't have high confidence in this one because if we have 100% on a 50 basis points increase in March, then the dollar should have moved higher. So I don't have high conviction that the bear flag will play out. What about gold? What's going on here? It did not close above the Three Amigos 1,835, and therefore I'm keeping the bear flag even though it is not a bear flag anymore. Yet it is really interesting to see how gold is going to react from this point on. We know for sure inflation is surging out of whack, and it will take years before taking inflation down to the 2% target. In the meantime, stocks are crashing, the bond market is crashing, cryptos, who knows? Is gold about to catch a bid as the safe haven it always been known for? We'll see. And here's a daily chart for the 10-year yield. A massive pop higher. We're now above 2%. Yes, the momentum indicators are way overbought. This chart is begging for a pullback. The problem is, where is the piece of fundamentals that will pull this chart down? The answer is, there is none. I'm not seeing any reason, any macro piece of data that could push bond yields at this point down. Inflation is surging higher, and the Fed is going to increase interest rates. The expectations are moving higher. We went from 25 basis points in the bag, now we have 50 in the bag. What's next, 75? How about a full point? I don't see any fundamental reason for this chart to pull down right now. And you have to remember this, the 10-year yield could rise higher for two reasons. There is a good reason and there is a bad reason. The good reason is the expectations of higher growth in the economy. And you know for sure that the 10-year is moving higher due to the good reasons if you see the Nasdaq and the high multiple names also moving higher in the stock market. But you know for sure that the 10-year yield is moving higher for the wrong reasons when the Nasdaq and the high multiple names underperform as the 10-year pops higher, because it is an indicator that the 10-year is moving higher due to inflation expectations, not growth expectations. And for now, the weekly chart of the TLT remains the same. We're going down to retest 134.5, and then we'll take it from there. Here's a 4 hours chart for the VIX. Look at this. It caught support from 20. And now what do we have? We have a crossing in the MACD indicator, producing green impressions in the histogram. All of these are good signs for VIX bulls, meaning market bears. We have a double bottom right now at 20. We have the MACD curling higher. The assumption for now is we haven't seen the end of this move to the downside in the SPY and the broader market. And here it is, a 4 hours chart for the VIX. Look at the MACD indicator, curling higher again. It's about to cross to produce green impressions on the histogram. We are above the magic number of 27.5. All of these are good signs for Nasdaq bears. The VXN is about to pop higher again, and this will produce another leg down in the Qs. And the Nasdaq, NDX, doesn't matter to me, what do you trade? But here it is, Apple, the biggest name and most important name in the Nasdaq. We still have a bull flag pattern, but it is not looking good so far, at least for today, because the chart is below 172.4, the most important support right now. Likewise, the momentum indicators are curling down and the volume spiked higher on the selling side. It's not looking good here. You don't want Apple to lose the bull flag pattern because that will be a confirmation that the Nasdaq is going down big. If Apple goes down, so will the market. And here's Tesla, an hourly chart, no update at all. It remains trading within range, waiting and waiting and waiting for buyers. If the buyers don't show up, then this will happen. We shift a weekly chart, or daily chart, excuse me. Here's a trend line. It goes all the way back to the summer of last year, perhaps a little before that. The problem is If this trend line is broken once again, it's over. Tesla will flush down all the way to the 600 range. Because here is what I see. What if this is a bear flag formation? And sooner or later, the chart will break below that trend line. If that happens, once again, we're going back to 600 sooner or later. And yes, there are some bits in the options market today, big time, millions of dollars buying calls on Tesla. Who knows what they're seeing here? What I see from a monthly chart perspective once again is tick-tock. It is gonna crash, and it's gonna be epic. And if Tesla goes down, it will be the biggest loss of wealth in an individual stock in the history of the stock market. Once again, tick-tock. We have bad news for the souffle, by the way. We have yet another one. The fourth recall in 2 weeks. Over 579,000 cars right now being recalled by Tesla. But perhaps the most important and damaging news that we got today for the souffle is the fact that California right now filed a lawsuit against Tesla, citing racial discrimination and hostile work environment. And this is not surprising to me, by the way. It's a bad culture, starting with the CEO all the way down to the culties. Listen to the culties sometimes. Some of the nastiest people I have ever encountered. Anyways, what about BTC, Bitcoin? Tulips, what's going on here? Surprisingly, while the stock market was down big, cryptos, in this case Bitcoin, held on. This is a good sign for crypto, but specifically Bitcoin bulls. But I'd like to see a retest to 42,000 before I say that we are out of the woods. And perhaps cryptos will outperform stocks in the next few weeks. I gotta see a retest to 42,000. Let's get it there. And what the bulls could be seeing right now is, what if this is, if we turn off all of the lines and drawings and we switch to a line chart, what if what we're seeing right now is a formation of a reverse head and shoulder? We need the, the left, the right shoulder, who cares? We need the other shoulder to be formed, and that will be formed if the chart goes down to retest 42,000. And then we'll take it from there. If it bounces, if it rebounds, then we have a reverse head and shoulder formation. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the most important University of Michigan Consumer Sentiment Index. And on the earnings calendar, we have Under Armour and Goodyear. Folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.